Thank you for coming. It seems that the tax law and the Jobs Act have presented an interesting topic, and appreciate everybody being here. We're going to cover 4 different areas. I'm going to cover what we're going to cover, and then we're going to talk about the 3 parts of the Tax Cuts and Jobs Act. I'm going to focus on individuals, but I am going to talk a little bit about the different C Corps and partnerships, et cetera. And I'm going to talk a little bit about how the real estate industry is going to be affected by this act. So these are the things really we'll cover. It's my opinion that the tax law, which is supposed to sunset after 2025, will sunset prior to that. And I'll tell you why I believe that. I'm going to talk a little bit about the difference between tax preparation and tax planning. And it's a real serious difference, and I'll tell you why. I'm going to talk about types of accounts, taxable, non-taxable, and I'm even going to talk about a tax-free account. And I'm going to leave you with some homework on the planning that you are going to need to do. So there are 3 basic areas to the tax cuts. One is large business. The second one is small business. And you probably read a little bit about that. And then I'm going to talk about individuals and some of the things I've looked at. The only thing I'm going to talk about in large business is that the corporation tax has been reduced from 35% to 21%. You've seen some of the effects of this. This act went into effect on January 1st of this year. And one of the biggest effects it's had on big businesses, you've read where they've given a number of their employees $1,000 of a bonus. They anticipated, when corporations get into the first of the year, they have already decided what their expenses are going to be. They're estimated everything else. So this came as a windfall to large businesses. But that's all I'm going to say about that. If you have a large business, then you need to be talking to your CPA right away. Now, for small businesses, those of you who are sole proprietors or LLCs or S Corps or have partnerships, you need to go talk to your CPA tomorrow. There's a difference between tax planning and tax preparation. You all familiar with tax preparation. You do it supposedly by the 15th of April every year. Tax planning needs to start on May 1st of every year. So each of you who have a CPA need to go and talk to them about how this is going to affect you. The question you want to ask is, should I stay, if you're a sole proprietor, meaning you fill out Schedule C, should I be an LLC, should I be an S Corp or a partnership? Because changing your, the way you operate may have a tax benefit to you that only the CPA can answer. Now, although this tax law went into effect on January 1st, everything's not clear. It's the way the government does things. So the IRS is still going through a lot of these things, trying to decide exactly what this means. As an example, so all of these 4 qualify for what is known as a 20% benefit. And by that, what that means is, if you were to end up, let's say you fill out your either a partnership form or a Schedule C, you come down to the bottom line and it says that the amount of money that you made in your business is $100,000. The way the law is written, And everything I've read says that you can take 20% of that number off, and only $80,000 will transfer to your 1040. So you need to go talk to your CPA and find out if you qualify for that, because there are a couple of entities that fit here that do not qualify for the 20% deduction. That's where I say, and your CPA might not know the answer at this point in time, but you need to do the research. There's got to be a CPA out there that knows what the difference is. This is a very big deal, taking 20% of your earnings and not having it taxed. Now we're going to talk about individuals, because it is my opinion that everybody in this room will be affected by this law one way or another. The new tax brackets are lower and wider. The singles, and incidentally, in your folder, there is a sheet, and it lists these tax brackets, so you don't have to copy everything down. But you can see on the left the new 2018 rates versus the 2017 rates on the right. So that the 15% tax bracket goes from 15 down to 12. The 25 goes down to 22. The 28 goes to 24. So this is an opportunity that you're going to be in a lower tax bracket. Many of you will find yourself in lower tax brackets. And it's an opportunity to take advantage of that, to move some money to your retirement accounts. And I'm going to spend some time on that and tell you how you can do that. Any questions about that form? Married filing joint, you can see that under the old tax law, that the 28% tax bracket on the right went up to $233,000, where now the 24% tax bracket goes all the way up to $315,000. What this means is that you're going to have some opportunities with more leeway to move some money, pay taxes on it now, so that when you're in retirement, in my opinion, these taxes are not going to last through 2025. New standard deductions. Prior to 2018, a single person got to deduct $6,500. Now it's all the way up to $12,000. Married filing joint, it went from $13,000 to $24,000. For singles over 65 to that $12,000, you can add another $1,600. So their standard deduction is going to be $13,600. And for married over 65, you're going to have an additional deduction of $2,600, which means instead of $24,000, you're going to have $26,600. So what this really means, it translates into most people will not be filing a Schedule A, where you did all your deductions for medical over 7.5%. And I'm going to show you what some of the new limitations are. That's a big deal. And it's an area that I started looking at some tax returns for some of my clients for the last couple of years. And almost everyone I looked at said, whether they were single or married filing joint, that they were going to do away with their Schedule A's. They were going to use just the standard deduction. These are some of the more serious changes on Schedule A. 2017 is on the left, 2018 is on the right. There's no change as far as medical is concerned. Any deductions over 7.5% of your adjusted gross income was the same as last year. Your adjusted gross income is the last number on the front page of the 1040. Taxes you paid. You used to be able to take all state taxes and all real estate taxes. That, effective January 1st of this year, is maxed out at $10,000. That's a serious thing in the real estate industry. On interest we paid, it was two things changed radically in this area. The first is that you could have a home and a second home, and your mortgages were not more than $1 million. You could deduct all the interest. You could even deduct interest where you had a line of credit. And as long as you didn't exceed the interest you were paying on that $1 million, you were fine. That changes. This year, for anybody that buys a house in 2018 is going to be limited on a mortgage, and the interest is only going to be deductible up to $750,000. The kicker doesn't affect mortgages that have been in place and stayed in place. The kicker is lines of credit. People have been using their house and the equity in their house as their own ATM. And so they'd take money out and they could use it for the kids in school, they could use it to take a trip, they could use it to buy something else. The lines of credit are only going to be deductible if the money is used to improve the home. That is a very big change. The gifts to charity, used to be able to take up to 50% of your adjusted gross income. Again, the bottom line on Schedule 1040. Now you can take up to 60%. Miscellaneous deductions have been wiped out. There was a floor on that. They had to exceed 2% of your adjusted gross income. The issue today is that nothing that you were putting on the bottom of Schedule A is deductible. It is gone. The estate taxes change. It used to be in 2017, $5.6 million of your estate was a deduction. That's per person. So for a couple, it was a little over $11 million. Now it is over $22 million. It's almost $23 million. What I would advise you, if you have a trust and you haven't looked at it in a long time, what the basic revocable trust said is at the death of the first spouse, they could put away $11 million, and that was going to go into a bypass trust. If you have a very old trust and it hasn't been looked at in a long time, it will tell you you have to do this. You don't want to do this. There may be some people in the room that have an estate that's worth over $23 million. But if you have something old, because the old deduction years and years ago was only $600,000. So you need to look at that. Now the gift tax has gone up from $14,000 a year to $15,000. Anybody in this room can give anybody else in this room or anybody in the country or the world $15,000, and there's no taxes involved from the person giving to the person receiving. If you give them $16,000 in the one calendar year, then that extra $1,000 has to come away from that 11.18 million. So it would be reduced by $1,000. You can give away the $23 million. That's 11.18 times 2. You can give that away during your lifetime, or it can go against your estate tax when you die. Now, the problem with giving it away while you're alive is that whatever you give away, that person receives the basis that you had in that property. Whereas if you give it to them at your death, it has a stepped up basis to the value, the market value of that asset on the date of death. Other changes in the law. Effective January 1st, 529 plans can now be used for pre-college expenses, up to $10,000 per child or per person. Be very careful of this, because 529 plans were set aside to put kids through college. If you start using it to help your child go to a private school, you can do it. And as long as it's taken out and used for educational purposes, there's no tax on it or on the gain. But 529 plans work very, very well when you start a kid the day after they're born and they go to school sometime when they're 18 or 20. So I'd be very leery of this one, but you can do it. Another change is Roth IRAs cannot be recharacterized. What that basically means is up and through 2017, you could move money from an IRA to a Roth IRA, and if things didn't work out, if the market went down, you could recharacterize it from a Roth IRA back to an IRA and recover the taxes you paid when you did that. That no longer is available. For the realtors in town here, the 1031 exchanges are limited to real property now. Used to be able to do different kinds of things. A big change that's going to affect many, many people are alimony payments are not deductible for divorces that happen in 2018 and beyond. It used to be the person who paid alimony could deduct it from their income, and the person receiving the alimony would pay taxes on it. That is no longer the case. And on any divorces, money exchanging, you're going to pay taxes on it. I mentioned the personal casualty losses about the car being wrecked. It's not deductible unless it's in a federal disaster area. Charitable deductions to colleges are denied in exchange for athletic events and seating rights. When I lived in Blacksburg, Virginia, the home of Virginia Tech, they are known as the Hokies. Please do not ask me what a Hokie is. Carol does ask me a couple of times a year. And so I used to contribute to the Hokie Club, a couple of $100 a year, and my football tickets, my football seating, and my basketball seating had preference. And I'm sure they do the same thing here at the University of Utah. That's not going to be the case anymore. You can't deduct that. Charitable, qualified charitable distributions, what are called QDCs, from Iras are now more advantageous. This only applies to somebody that is over 70 and a half and must take a required minimum distribution. As you know, basically when you take money out of a retirement account, you have to pay taxes on it. If you're over 70 and a half and you're required to take what is called the required minimum distribution. If you set it up so that the money goes directly from the custodian that's handling your account to the charity, that's a tax-free exchange. Now, it doesn't mean, suppose for an example that at 70 and a half, you've got a couple of $1 million in your retirement accounts and Iras and 401ks, et cetera. And the required distribution will be approximately 3.5% of that number. So you were talking somewhere in the neighborhood of, let's call it $7,000. A lot of times people don't need that money, but they take it out and it becomes an income to them. It must be declared on their income taxes. If they decide they can take any part of it, they could take half of it and have it sent to St. Mary's or Salvation Army or any charity of their choice, and that's not a taxable event. So if they had a distribution of $7,000 and they took $3,500 and sent it to the Salvation Army, and they kept the $3,500 for themselves, they would only be taxed on $3,500. Let me talk a little bit about what I would do if I was in real estate. In real estate, you were able to take money and all your state taxes, et cetera, could be taken out. Now, a lot of that is going to disappear. So if I was marketing in a realtor, what I would do is I'd switch my deal to say, the American dream is not dead. It is the American dream to own your own house. And I would focus on that. The other thing I would focus on is people really think they're getting a big deal when they get to deduct something on Schedule A. So if you're in the 25% tax bracket, for every dollar you get to put on Schedule A, you're saving 25 cents. And I would let people know that. But if I was a realtor, I'd be thinking about having my story ready when somebody says, nah, I don't think it's worthwhile to buy a house. I would put on the emotional deal and I would tell them, really, those deductions you had really weren't as great as you thought they would be or are. I want to talk about types of accounts. There are taxable, tax-deferred, tax-free upon withdrawal. There are tax-free accounts. And I'm going to tell you why I believe the rates will rise and why you have the need to plan. Well, these are the kind of accounts that are taxable. Savings accounts, CDs, salaries, obviously. Non-qualified accounts. A non-qualified account is nothing more than an account that does not have something in the tax code that says you have an advantage. For instance, you put money into a traditional IRA, you don't have to pay taxes on that. It grows tax deferred. Only when it comes out is it taxable. But some people will use annuities and will have a non-qualified annuity. And when a non-qualified annuity has an advantage, it will grow tax deferred. But the first money out of that is going to be taxed. Tax deferred accounts, traditional IRAs, 401ks, 403bs, 457s. The latter two are basically the same as 401ks. When you see these numbers, all those numbers are as a reference to the IRS code, the section of the IRS code where they're covered. Tax-free upon withdrawal. Roth IRAs, they go in with after-tax money, they come out tax-free. Cash value life insurance. When you build up cash value life insurance, the money coming out of there The first money that comes out of there is the premiums you paid. So it's a return of your money. After it builds up an amount of money, you can make after you've withdrawn all your premiums that you paid, you can borrow against it. When you borrow against anything, there's no taxes involved. Reverse mortgages will work for some people. And if somebody is thinking about a reverse mortgage, one of the things they want to think about is if they want to stay in the house that they're living, please make sure it's on one floor, because when you're 85, climbing stairs is not a good idea. Anybody with one of those hip transplants want to say something? So, tax-free. Who knows what a tax-free account is? Who knows an example of a tax-free account? You didn't know there was one, did you? Health savings account. This is the best savings deal for retirement that you can think of. But you never thought of it as a retirement tool. You thought of it as a way to pay your medical bills while things were going on. What happens with an HSA is you can put in somewhere in the neighborhood of $6,500 over a married couple. You must have a health plan that has a high deductible, and you can put that much money away. You can then use it anyway for any health thing. You could use it to pay off a prescription. You could pay it a doctor bill. And what you don't use in any one year will roll over to another year. So my advice for the younger you are, put as much money as you can into these things and do not use it to pay for prescriptions. Pay for them out of pocket. There are different ways. There are people who are now using HSAs and they're not looking to use it for this year or next year. They're using it for retirement. And they're looking for ways to invest it that makes a better return. 5, 10 years ago, there was not any place where you could have an investment that was going to have a return. That's no longer true. So depending on what your idea is, you can take and find HSA people who will take HSA investments and will turn around and have a better return. I think it's been the most hidden retirement account that you can find. So when you're in retirement, you can use HSA funds to pay for Medicare, Parts B and D. B is doctors, D is drug plans. I talked about qualified charitable distributions before, so it's another tax-free that you avoid taxes on that. Inheritances are tax-free, and life insurance death benefits are tax-free. Here's my opinion of the future of tax rates. I don't think you're going to see 22% or 24% in 3 years. I think if you have a change of administration this year or next year, this year or 2 years from now, they're going to change. They'll change this. But Social Security and Medicare consume 60% of the federal budget. I'm going to show you a chart in a little bit. Just last week, there were a number of articles that I read that Medicare and Social Security are running on IOUs. There are now more money received monthly by Social Security recipients than is coming in from from people who are paying taxes. Taxes are going to have to rise. And a rise in taxes while you're in retirement can be a disaster. When you're 65 and you still have a bunch of money in Iras and 401ks or whatever you have, the bill's going to be due. And every dollar that you take out of to pay taxes is a dollar you can't spend on going to the bar in here. Yeah. The blue and the red are Social Security and the health. Almost an entire 60% of everything else. The Congress does not want to face the issue of Social Security nor Medicare. Medicare runs out in 2028 under the new announcement last week. Social Security runs out a little bit later, sometime around 2033. And the longer they put it off, the more draconian the effects are going to be. If you are, in my opinion, if you are in your 50 or older, you probably will not be affected. Howsoever, when Social Security reaches a point in 2033, there'll only be enough money to pay 75% of the benefit. So if you were getting $1,000 a month, that says you're going to get $750 a month. I am an optimist by nature, but I will tell you, the country cannot continue to run a deficit each and every year on a debt that's already $21 trillion. And you see here with the red line where the total cost of Social Security, and this is from a Wall Street Journal article 2 weeks ago. So this is fresh information. It's already crossed the line where the total cost exceed total income. And if you remember what happened, remember the talk about the lockbox years ago in Social Security? What was happening is, instead of going into a lockbox, the Social Security income was being used by the Congress to run the nation. And they threw in an IOU. Those IOUs are now being called back, which means really, if you think about it, that the Congress is not going to have as much money to spend because now they're limited. So this thing is going to come crashing down until somebody does something about it. And nobody wants to do anything. So here's a question for you. Why chase money when you can keep the money that's already in your pocket? No, if you say, hey, I got to go out and I have to earn some more money because I need something, for every dollar, suppose you're in a 40% tax bracket. And they said, well, no, I'll never be in that high a tax bracket. Well, if you figure you're in the 25% tax bracket, there's a 5% tax bracket from the state of Utah. And don't forget, you're going to pay FICA tax on that, which is another 7.65%. So you're already up to almost 40%. That's not a big number. That's really something to think about. But if you saved a tax dollar, you didn't have to spend it. If you knew what to do and look at the IRS code and figured out with your CPA how to save that a dollar, that's a dollar in your pocket. You already have it. You already earned the money. So let me ask you, when was the last time your CPA called you and said, I have a way to save you $5,000 in taxes. When can you come to my office so we can discuss this proposal? How many hands? There is a real problem with understanding what a CPA does. A CPA is a wonderful occupation. And the CPA exam is extremely difficult. It's a 2-day exam. There is not one question on the CPA exam on how to save taxes. It just teaches you which box to put on in which form, which number. Now, some of you have discovered better CPAs than others. But don't think that CPA stands for something about saving. It stands for Certified Public Accountant. What does an accountant do? He looks in the rearview mirror. He puts and looks at what you've done. It says, now, okay, here's how much you owe. January 1st is too late to start. May 1st is the date you need to start planning, tax planning, so that get into a lower tax bracket. Now let me talk a little bit about why I said you can have some ways to save and put more money away into some for retirement. If we went back and we looked at those tax brackets, we were already up to $330,000 and we were still in the 24% tax bracket. So if you only made $275,000, there's that other amount of money that you could say, okay, I can take another tax, I could take some money out of my IRA or my 401k and still stay in the tax bracket, pay the taxes on it. Now I can do it and invest it in some other areas. Some other areas are cash value life insurance. That can't be any old cash value life insurance. It's got to be based on, see, different life insurance companies have different policies for different people at different ages to do different things. All life insurance policies are not the same. And the other thing you have to know about life insurance policies to make these things work, to give you an advantage in retirement, is that you have to overfund them. So if it says that the premium is $7,000, you probably want to pay $11,000 to build up the cash value. Now, years ago, the big thing, the only thing to sell was term insurance, which is pure insurance, or whole life. And whole life, it works very well if you can last 15 years, because in the 15th year, it turns on a spigot of money for you. But a lot of people don't have 15 years to wait, but there's some other things. Please don't confuse what a CPA will do for you. And I know there's some people in this room have found some new CPAs to help them, and call them tomorrow, make an appointment, and get on with it. There's a big difference between tax preparation and tax planning. Tax preparation happens from January 1st to April 15th, and then extended to June 15th and October 15th, but it's too late. Too late. Any questions? Okay, here's the need to plan. You need to maximize your HSA. If I haven't made that any clearer, I mean, see, you've got to do that. And if you can avoid using the money for prescriptions and those kinds of things, you should do that. Move out of tax deferred accounts now when you are still working, you still have some opportunities. Pay the tax now when you have lower rates. These rates, in my opinion, are not going to last, but for the next 2-3 years, get as much, bite the bullet now. There are about 4 or 5 different ways to get money into Roth IRAs other than contributing $6,500 a year. And I'd be glad to cover those with you. I think cash value life insurance is I've studied this, I've read a couple of books. If you would ask me this question 6 years ago, I would have said, buy term, invest a bit difference. And I did that. But when I wrote a book, and the second half of the book is all about this tax bite that is going to kill people because they've saved money. When you have the opportunity to move in and have as low a tax bill as you can at age 80 or 85, you need to do it now. Bite the bullet. Reverse mortgages are another consideration, but again, if you're going to do that, you got to think about, do I really want to stay here? Is this where I want to do? Do I want to shovel snow? What is it? And it's got to be on one floor. So, well, that's speaking of getting things done in 1 year. We talked about how people are going to use the effect of Schedule A's. If you can bunch medical bills or things like that into 1 year or postpone income, that's another thing a CPA ought to be helping you with. But if you don't start the discussion, it'll never happen. I am suggesting that you contribute to a 401k up to a match. If there is no match, then the first thing you start with is a Roth IRA. If you have you figure out what your tax bill is going to be, what the difference is going to be, because you're going to stop shielding money from today's taxes. But yeah, I've always, for 10 years, I've said the first thing you do is put the money into a match. If there's no match, then you go to a Roth. And if your company offers a 401k a Roth 401k, that's where you want to be. And if they're not offering it, you want to go talk to your human resources people and say, you know what, I'd really like to have a Roth 401k. Doesn't cost them anymore. I mean, they don't keep the books. They hire people to do that. The limit for a contribution to a Roth has something to do with how much money you make, but if you're eligible, it's $6,500. But there are some ways called a backdoor Roth for people who make too much money that you can do that. I can fill you in on some of those things on a one-to-one. Mike Stone is doing a recording. Mike's been here in Park City since 2000. He does a lot of video. If you know Chris Waddell, who is a paraplegic Olympian, and Chris climbed Mount Kilimanjaro in his wheelchair, and Mike did the video of it, and it's probably available. So he does a lot of video work, and you get onto his website and see some of his pictures. I know you've been waiting for the disclaimer, and I'll wait a little while. I know there are a couple of people who have been taking copious notes, and you'll want to get all of that. Thanks for coming.